I can just click on the side, right? And it will, yeah, okay. All right, so in this, my part of the presentation, I kind of thought about how do I want to do this? How do we want to try to teach this? And I want to do something a little bit different than what I normally do. Now, typically, we'll see, we'll read a book and we'll have a trade set up there, and we'll see some nice little chart examples about how this thing works. And most of the time, those chart examples are going to be perfect, picture perfect, right? Not really show you what the true nature of the market is. And I don't think that's very fair, truthfully. It's great for selling snake oil, or great for selling, it's great for the people who are putting that kind of stuff together and selling it. But it really doesn't tell you or teach you about the markets. So what I decided to do is a little bit different. And I'm not sure that this is going to work. It may not work, but I think it will. And that is, I'm just going to take a recent week in the S&Ps, which is what I trade most. And I just want to go through that week in some good detail so that you can see the principles of Wyckoff, some of the contributions that Tom Williams has made, and of course the contributions from my mentor, David Weiss, has made to this pretty phenomenal method. I just want to take you through it on sort of a holistic approach. And we'll go deep into the charts, as deep as I know how to go. And Gavin and Steve and David are welcome to jump in at any point. And questions are encouraged. And, because it's going to be kind of a holistic approach, it may seem, if you haven't seen this material before, maybe it's going to be a little confusing to you. And I'm not sure what I can do about that except to just ask you to go back and review the tape later on. And try to integrate some of the things that I'm talking about in kind of an overview approach with the things that David and Steve and Gavin will talk about later on. And they'll be giving more flesh and more detail to the things that I'm reviewing here. Okay? So what we'll look at is a week in the intraday, and if we have time, we're going to go through a popular stock on a weekly basis. And then we'll just summarize a little bit about how to apply this material. Okay? All right, here's the first chart. And before we even start looking at the chart, what I want to do is I want to orient us to this chart so that you can see what this is. First off, it's not a time-based chart. We had a question here from Jack earlier who said that, when I look at overnight data, I get the charts from my broker every morning, and I look at the overnight data, and there'll be one big bar in there, and then all these little things, and I can't really read this. Okay. That's the case in the S&Ps, even though it's probably the most actively traded U.S. market or U.S.-based market around the 24-hour cycle. If we were just looking at a 5-minute or a 10-minute chart, which this is approximately that, we wouldn't be able to see the overnight action very well. This is called a tick bar chart, or more properly, an equitick chart. Equitick chart. What's an equitick chart? It's a price bar that is based not on time, not on 5 minutes or 10 minutes or an hour. It's a price bar that is based on trading activity. So when it's 9,000, and you can make it a 27,000 tick bar chart. This software goes up to 65,000 ticks per chart. You can go down to 1 tick if you want to. In the S&Ps, most days, given the current activity, a 9,000 tick bar chart is about a 5 or a 10-minute chart, give or take. Used to be we would use a 1,000 tick chart for a 5-minute equivalent. But with the additional activity now, we have to, and that's going to continue to change over time. All right. So what is this activity that I'm talking about? Well, it's trades, and more technically, price changes. So in each bar here, there are 9,000 changes of price, 9,000 times that the price changed. Right? That has the effect of compressing the market overnight into a readable form. And you'll see that as we go along, as we progress through this week, you'll see a nice, smooth data series here, which is very useful. It acts just like any other chart that you've ever seen, any other bar chart. And I just use the open the high-low close, not the open, just the high-low close. That's all that's really needed. Although I know that many people do trade candlesticks, and sometimes you'll hear me say some negative comments about candlesticks, and I'll explain why I do that. But I'll try to also relate candlesticks to the best of my ability here as we go along, so you get a sense of how you might be able to integrate that, your own trading with this. So what does a 9,000 tick bar chart do? Two things. It compresses the overnight data, and if you were using an indicator, if you were using a MACD or an RSI, and I know many people do that, this standardizes the data set for you so that your indicator is giving you a true reading. A 5-minute price bar really doesn't do that, because 5 minutes is just based on time, not on activity. So this standardizes it across, and you have decent data. And in fact, I don't really look at time-based charts below. Now I look at a 240-minute chart, which is a 4-hour chart, and I look at a daily, and a weekly, and a monthly. But below the 4-hour, I'm using all tick charts these days in my trading. All right, so that's the basic chart. And on this chart, I have, you can see, let's see if I can use this. Change the color here to blue. And you can see I have these funny-looking triangles down here. Well, this is volume. And this is the Weiss wave. This is the volume component of David's pretty phenomenal little indicator that measures the volume of the wave. Wyckoff thought and conceived of the market as behaving in a wave-like structure. We have, for example, a down wave and then an up wave. A down wave and an up wave. Down wave and an up wave. A large up wave occurs here. And what David has done, I don't have, you'll see when David shows you his charts, that many of them will have the actual wave line on the price bars. I've taken that off so that we can see the price bars a little bit better. But normally when you use this wave chart, when you use the Weiss wave, you want to include the wave, the waves over the price bars as well. Now, down below, and I'm just going to give you an orientation to it. David's going to go into all kinds of details with it, and he'll explain how to use it, and I'll show you how I use it in this, but he'll show you actual setups and so on and so forth. Again, what I'm trying to give you is I'm trying to give you the sort of soft, fuzzy approach, if you will, to kind of let you step back a little bit from the hard right edge of the chart. Everybody's eyes get glued over here, and they want to make trades over there. I'm going to, as you heard Gavin say, that part of VSA is understanding the background. And that's really important in VSA. Well, it's important in Wyckoff, too. And really, I think about the background in terms of the structure of the market. Okay, what's the market structure look like? And how can we trade within the context of that structure? How can we trade within the context of that background? Start thinking in those terms, and your trading you should see some improvements in your trading, as opposed to having your eyes riveted over here. I want you to take a look at the whole chart and start to understand what's going on in the chart and what then we can do about it as traders. So just to complete the Weiss wave, we look in terms of waves on the price bars, which are not drawn here. I did them by hand. And then these green and red triangles down the bottom pane of the chart is the volume on each of those waves. Very, very interesting. Because what this measures then is the demand coming into the market and the supply coming into the market not on individual bars, but on waves, right? On moves. You can think of wave as a swing. Right? And David will go into much greater detail about that. All right, so how do we start to trade this? How do you think we want to? This is the day's data here, day number 2. You can see that here. Day number 2, complete data for that day. How would we trade this? What would we begin to notice about this market? Pardon me? Trade it short? Well, maybe, if we were looking at the end of the day, but let's go through the day and see what we can see here. First thing I would do is I would look at yesterday. Okay? And what do we see from yesterday? Look at day 1 here. We see a downtrend. Right? What's occurring? The market's moving down. Kind of what I would call a grinding down move. We're not seeing large swings and large waves here. We're seeing some, as you can see from the volume here. But we're moving progressively down and down and down. And as we move down, you can see that the volume is very strong to the downside. We have supply or selling coming into the market. And for anybody to have gone long here would be a trading error, really, on this day. Right? When we compare the up volume, here's an up wave here, right? Very close to the end of the day, and we look at that volume that comes in. It's nowhere near in comparison to the other waves here in terms of amount of volume. There's just really no demand in this market. Right? Everybody see that? Everybody get the idea? Okay, so we're in a down move, and it's an intraday move, and sellers got short, people got short, some people tried to buy and they got hurt. What happens the next day? Anybody have an idea what that might be, what that might look like? Sure. Mm-hmm. Right. The way the wave works is when we're in a down wave, it'll require a certain amount of price movement to change it from a down wave to an up wave. And the way that we have it set up here is right. That's correct. So, for example, here, I'll label this A. This is a down wave, and this is the volume associated with that wave coming down. Down volume. We have a little rally here, call that B, and it's kind of hard to do this, but this is the up wave volume associated with that rally. Very light volume on the rally, so not much demand. This is wave C, and this is the volume right here. I boxed it out. That's the volume associated with this down wave C. So from this, what we can immediately see is that sellers are in control because they sold here and they were strong. We see that in both price movement and in the amount of volume coming into the market. On the rally up to B, buyers tried to rally that, but look at what they could do. The wave up is not even half the size of the wave down. Right? And the volume at B is very minuscule. So no real demand is coming into the market. Sellers see that, and they immediately come back into the market and drive the market down lower in wave C, and you can see all the volume that comes in it, all the selling that's going on. So this is a very weak market coming in. Okay? Good question. And so the next morning it opens. We see a gap open. It's probably a Sunday mistake, actually. we see a gap open, and we just plummet straight down. And this is, at the time, we would call it a potential selling climax. Selling climax, where the sellers, where everybody is selling all at once to try to get rid of, this occurred and ended at one night, and everybody looks at the market overnight and they say, oh boy, we're going down. I better get out of my position. So they're liquidating positions. And they do it all at one time. And we call that a selling climax. And we can see, I'll show you other examples of the climactic action. But typically we see almost a straight move down on a selling climax. We see wide price bars, wide spreads or ranges in the price bar, which is the difference between the high and the low. Spread or range is an equivalent term. Okay? And it just signifies capitulation. And it often marks the end or the near end of a move. Now, on the next slide, notice what I've done here. I've circled those price bars. What do we notice about those price bars? What do we notice about what's inside the circle? What do we notice about those closes? Anything? Closes are high. They're coming off the bottom, right? What would do that? Only one thing, and it's not selling. Right? Buyers are coming into the market, and they are forcing the closes to be up higher because they're buying into it. Typical of what happens in a climactic situation. What else do we notice about those closes? They're all basically in the same area, right? They're all within a point or two, or a half a point of one another. So over 1, 2, 3, 4, 5 bars there, 4 or 5 bars, the sellers were unable to move the market down. Still pretty good volume, especially for the overnight action, right? Still pretty good volume. But they were unable to move that market down. It's another principle we talk about in Wyckoff terms, that there's a lot of effort, a lot of selling here going on. But the result is pretty clear. If you're a seller, you want to see that market drop because you're betting that the market will go lower. But here, all the sellers are coming in, and they're not able to push that market down. Another typical characteristic of a selling practice. So a lot of effort in terms of volume. It's like a car, right? Where's the effort? It's going to be on the gas pedal. You step on the gas pedal. The fuel is the effort, the gasoline. And the result is we go down the road. Right? Sometimes, though, we're on ice, right? Or we're stuck in mud or snow. As much gas as we give it, we don't move forward. We have no result for the effort that we're putting into that car. And that's what's happening. And then the market turns up. And look at the move up that we get here. Go to the next slide. Yeah, look at the move up. And look at, I labeled it A here. Look at all the demand that's come in. So now we're looking at this, and it's about, it's just after the open here in the market, right? And we see now that yesterday was a down day, a pretty big down day. Then it went further down and got climactic. We see that there was a lot of effort in the overnight market. This is fairly large volume for the overnight, where the trading is more, it's not as active generally as it is in the U.S. sessions. And so we see that climactic action, and we see the clustering of closes and the inability of the sellers to push that market down lower, effort versus result. And then what do we see? A nice rally up, and the demand comes in. Look at the size of that demand. Compare it to yesterday. There was no demand yesterday on the up wave volume, right? The up volume. But today, suddenly, demand has come into the market. So there's been a change of behavior, hasn't there? Yesterday's behavior, it was all selling. You couldn't buy a buyer, right? If you think about it, the buyers were very, they were not aggressive at all. Today, the behavior's changed. Now buying dominates the market. So as we come into this, into the U.S. session, around 9:30 or 10 o'clock in the morning, Eastern time, New York time, we want to look to be a buyer because behavior's changed. And we see that in the chart. The structure of the chart has climaxed, it's held, and now we see demand strongly enter the market. Okay? Any questions?
Yeah.
Good.
One says that weakness is not not but one of the cards that is very high for you not sell.
Mm-hmm.
So make you think that person is really not exactly the instance ultra high
Right. And I will. And Gavin asked a question. He says that Tom Williams often says that ultra-high volume on uprise are, generally indicate weakness. But here we have that ultra-high volume on A, and the market's going up, and then it holds and it continues to go up further. Why is that? Well, it's the background. It's always going to be the background. You have to keep that in mind. And the background here is we have climactic action and a holding of that market and a lack of ability on the sellers to push the market down. Smart people who understand how to read the market, the smart money, the professional traders, and us as well, if we're in tune with the market, we notice that. And we say, well, we want to buy them. And so buyers who can read the market like this become eager to get in. And they're willing to pay up for that market. To buy that market. So a rally on high volume in this context, remember I said what we want to do is relate structure, our trading we want to relate our trading to the structure of the market, to the context of the market. So in this context, this is very bullish. It can seem confusing, I know, but you have to be able to see that not only there's other ways to look at this too. Not only are we moving up on strong volume, but we rally back up through the down gap, the gap down. Right? And we rally back up into yesterday's close after a strong gap down and a strong move down. Not only that, but we see the biggest up wave since the down move began. And that's a change of behavior, what we call a change of behavior. Very important. So we see this coming into the market, and so we want to be buyers. We want to look for a buying opportunity. And shortly after the open, within an hour, we get a beautiful buying opportunity. Anybody know I've got a green arrow there, and we'll go through this in some detail. Why is this a good opportunity to make a long trade? Why is that a good opportunity? Anybody have an idea? Besides the background conditions that we have here, in terms of the climactic action and the good solid rally up. I'm making it right here on this green arrow. That's where I'm buying. Okay? Mm-hmm. Jack says that we have a move down with not much, some volume coming in, not much move down, not much price move down, which is exactly right. We can see here that we've had a good rally up. Now we expect some sort of a pullback, right? Look at the character of this pullback. It's basically going sideways. We're not seeing a strong pullback, are we? Okay? We get a little volume here, not surprisingly. There's some profit taking going on. But it's nowhere near the volume that we saw on that initial wave up. Okay? This is momentum that's come into the market, what I call new momentum highs. If you were looking at an oscillator, like a MACD or a 310 oscillator or an RSI, you would see that oscillator jumping to new momentum highs. Okay? Well, we don't need an oscillator. We can see that in the structure of the chart. We can see it on the waves of the chart and the wave volume of the chart. New momentum high. And then we just go sideways. We don't do anything. But at the very edge here of this little tiny trading range, what happens? The market dips down underneath the support level that it had established a couple of bars back, a few bars back, finds no supply down. Look at the small, narrow range of the bars. We have bars are a measure of activity. Remember, I'm using a 9,000 tick chart here. Okay? So all the activity is the same. Look at the small range. This is effort to go down. There's 9,000 price changes in here. Somebody's trying to push it down, but somebody else who's stronger is holding the market right at that level and not letting it go down, because for everyone who's selling, somebody else is in there buying. Somebody stronger is in there buying. And so we get that compressed price point. Okay? That's not much different. It's just a different look, but it's not much different than what we saw over here. And you're going to say, well, wait a minute, how does that work? Well, we have a lot of effort to go down here, right, with the volume when we don't get any progress going down. Here it happens much quicker, and it happens a little bit different, but there's still 9,000 price changes in there, an effort to go down, and there's no result. Okay? And then the very next bar is our confirmation that we've got buyers stepping back in. This is a spring, and this is where we can buy. This is known as a spring, where the market establishes a level of support, rallies a little bit away from that, and comes back down underneath that support level for a bar or two. And don't get hung up on how many bars. It's less important than seeing the concept at this point. And David, I'm sure, will talk about springs. And there's more to I've got more to come on springs too. And then the market rallies back up above that support level. That's a spring. And it's a wonderful trade, especially in this context, because we have buying coming into the market. So we want to be a buyer, and this is a perfect spot to go long. Yes? You know, it would relate to the wave down. The question is, does the volume on B relate to the narrow spread bar? And not quite. It relates to the volume. I really should have put the wave chart up first. There's a wave down that occurs here. See, I can see this in my own charts, the waves occurring, and I can certainly read it from the volume. So less is more for me, so I try to have as few things on the chart as possible. So the volume on B here goes from the volume on this bar to the volume on this bar. It accumulates. It adds all this volume up, and it reflects it here. So this is a buy point. We don't have to get into the market at the bottom of, we all try to buy the low tick. That's probably not a good idea to be doing. What we want to do, I would encourage you to, instead of trying to find the best entry point, make sure you're connected to the structure and the background of the market. Then look for an entry point. Okay? Then look for an entry point. And that's one here. So how do we manage this trade now as we go along? Well, notice also that yesterday's low, we rally up above, and I'll talk a lot more about this as we go along. I view yesterday's high and low in intraday trading the S&Ps. And if you're a swing trader, last month's high and low, trading off of the weekly swings. If you're a position trader, last year's high and low. Okay? Doesn't matter the time frame. It really doesn't. You can just bump this up and to the time frame that you're trading on. And you'll see the same exact principles at hand. And that's because the market's fractal. It moves the same on a 5-minute chart as it does on a monthly chart in general. But we went underneath yesterday's low, and we rallied up above it, and we held at yesterday's low. It's another indication that this is very bullish. We're not able to drop down below yesterday's low. We spring off of it. So how do we manage this? I like trend lines, simple, basic trend chains. And let me show you how to draw a proper trend chain. We wouldn't draw it until, I'll put a mark here, this bar here, this large bar coming up. We wouldn't be able really to draw the trend channel in. But what we want to do is we want to take, in this instance it's the low, we want to take two swing lows or two wave lows, two significant swing lows here, and I've labeled those A and B, and just draw a line connecting A and B. That's our demand line. That's where demand, think about it this way. We have demand coming up and some supply comes in. Demand stops the supply at A and rallies up to C. We see some more supply come in and brings it down to B. Demand steps in again, demand being buyers, supply being sellers. Buyers step in again at B and rally the market up. So demand is coming in at A and B. And that's where we draw our basic trend. And we take a parallel of that. It's very simple. Very simple. We take a parallel of that and we attach it to the swing high, or the wave high, between the two wave lows. So we attach that to C. And that gives us the stride, or the angle of ascent for this particular move. You can see that it conforms pretty well. And so when it gets up into the higher area of this parallel line, we call the lower line in an uptrend, we call the lower line the demand line, the higher line the supply line, because this is where we expect supply to come in. Right? It's all based on demand and supply, all based on buying and selling. We expect buying to come in along the demand line, we expect selling to come in along the supply line. And you can see, it's a little subtle here, I must admit, but you can still see that once we get up into this area, we get that clustering of closes. Once we're up where we expect supply to come in, we're getting that clustering of closes. Same thing that we saw down here. We're seeing it now up here. And that's our exit point. That's the market signaling to us, okay, Gare, time to get out. You did a good job. And so, I don't know how many points this is. Let me just take a quick look here. About probably 7 or 8 good points, S&P points in this kind of a little swing. Right? A nice trade, a very nice trade in the S&Ps. Could we have gotten in down here? Yeah, if we were an aggressive trader, we could buy that. And some of us might do that. But the easier, safer, more relaxed way is to first notice the change in behavior, understand that structure is, the market has now pushed back up to yesterday's low and is holding its gains up there, and then it gives us a spring. And it dips down underneath that support and says, there's no more supply down here. Let's go higher. And there's our entry point. And we construct a little trend channel. We wait for the market to get up towards the supply area. We see the clustering of closes, the inability to push that market higher. We say, thank you very much. We'll take our 6, 7 points. And it's a nice day. This is how we use Wyckoff, or at least how I use Wyckoff. Good observation. Jack makes a very good observation. He says that, I'll just label this as C here. He's saying, you got some big volume in here, bigger than A, this last wave up. And, if you look at the wave, and here's the wave here, you can break it down a little bit if you want to, compared to the last wave here, gee, you got so much more volume, but the wave is smaller. Does that tell us something? Yeah. It tells us, look at where we are. If we go back to yesterday, we're at the point where demand was having difficulty, right? So we're at that point. So the supply has come back into the market, potentially. That's how we would read them. Very good, John. Very, very, very smart question. Very astute. Yeah. How's the temperature for everyone? All right. So how does this seem? Does this seem useful to kind of look at the markets these ways, to kind of look at the chart these ways? It's a little different, I think, than perhaps many people are used to. But let's see what we can learn now if we go on to day 3. So here's yesterday that we just looked at, day 2 over here. And now we have day 3. And so, Jack, look at what happened. On that volume up, we saw effort to go up, met with, a little bit less result than we saw here. It's clearer here now, isn't it? Because I've changed the orientation of the charts. And now we start coming down. So what do we notice on this chart? What do we notice here about what's happening on this chart? No buying at all. Well, there's a little bit of buying down below. Yeah. First thing that I would notice is that here's that low from yesterday that we sprung off of. Now look at what happened. We're back down below that low. Son of a gun, huh? When we're trading the S&Ps, if you're trading intraday trading any market, but in particular the S&Ps, pay attention to yesterday's high and low, the 2 or 3 day high and low, the ones that are close by, because they are significant. It's where demand or supply stopped on the day before. How much time have I got left here? Okay, good. All right, so I'm gonna pick up the pace a little bit because I've got a lot of charts here to go through. We may not get through all of them. That's okay. What else is happening here? What's happened here compared to this arrow here? What's happened? Pardon me? I'm sorry, I can't quite hear you. They jumped. Yeah, they broke the ice. Actually, they came down below. But what's happening here? What's happening here? Oh yeah. Okay.
You just mentioned two terminologies.
Yeah, I know. I didn't want to do that. Gavin said you just mentioned 2 terminologies, and no one knows what you're talking about. And I realized it as I was saying it too. And I said, oh God, why did I do that? Okay. This is falling through the ice, and it's a story about supply coming into the market. And it comes from Bob Evans, who was the director of education and actually owned Wyckoff Associates back, when did he own? Jacob, 40s, 50s, 60s, I guess? Yeah, in the 40s, 50s, and 60s. Wyckoff had set up an educational organization to continue to educate the public on trading the markets. And Evans was a very, very good trader and a very, very smart man. And he wanted to make sure that everybody understood what was going on in the markets in the easiest way possible. And so he used to tell these stories. And of course, in the 40s and the 50s, it was just after the Second World War. And here in the United States, the Boy Scouts, and I think in England too, the Boy Scouts was a very up-and-coming organization. I remember I was a Boy Scout as a kid, and just about all of my friends were. We all thought that was really cool. So Bob Evans would talk in terms of, in his day, the Boy Scouts, that there was a Boy Scout walking along a lake, a frozen lake. And he'd walk along here and he'd see, oh, the ice is a little thin here, I better go around that, but doesn't go through the ice. And he's meandering along the lake, but comes to a thin spot in the ice and falls through. And there's a current with this lake. I guess maybe it's more of a river than a lake. And it carries the Boy Scout downstream of that. And he's, of course, frantically trying to get back up above the ice because there's no air down there. It's all water. But he bumps his head on the ice, passes out, and drowns and falls to the line. And that's the ice storm. Right? I'll talk about jumping across the creek a little bit later. There's another Boy Scout story, and that's a story of demand. It's just the opposite of fall through the ice. But that's the idea here, falling through the ice. When we look at this chart, we say that it's back to the 2-day low, and it's falling through the ice. We can see that we have wide price bars coming down, pushing down, driving down through that ice level, ice being the support level, or that 2-day low. We make a lower low. How do we define a trend? Yeah, lower low, lower high. I do it very simply. There's no need for complexity here. So we have a low here, we have a high. We make a lower low as we drop down through the ice. When that Boy Scout tries to get up above the ice and bumps his head, we put in a lower high. And now as we go back down through it, at this point here, where the red arrow is, we now are in a downtrend. Okay? We're now in a downtrend. Or we can drop down to a smaller time frame and look for a selling opportunity right in here. Maybe go down to a 3,000 tick chart, where there would be 3 bars to every bar here. Okay? And integrate that. Now notice, what do we see here? We've come down, made support at this lower low. Buying came in here, rallied the market up, tried to get above the ice, bumped the head up the ice, comes back down. And now we see a couple of bars here where we dipped underneath, but we're closing back up. Doesn't that look like a spring again? It does, doesn't it? It's the same thing that we saw over here. Right? When we had that line go across. And it is a spring. Technically, it is a spring. But we want to be aware. We want to be aware of the structure of the market, of the background of the market. And we've just broken down once again through the 2-day low. Why would we want to buy that? Now we have weakness in the market. We say that springs in a downtrend are usually not a good idea to buy. When we're starting a downtrend like this, it's not a good idea to be buying a spring. We're making lower lows, lower highs. We have a level of what had been support over here yesterday now becomes resistance when it gets broken. It's a classic. So we can look for opportunities to make a trade. Also, notice on this spring, on the up wave after the spring, there's no volume. There's no upside volume. And this is at 9:30 in the morning. This is at the U.S. Open. There should be a tremendous amount of volume. Look at the volume that we had yesterday around the Open. Compare that to today's. Always going back and forth, comparing waves and volume of wave with the most recent waves and the current wave to assess the strength of the supply or the strength of the demand. And here demand is weak again. And we can look for an opportunity to take a short there as we're starting to punch down through. I just wanted to give you a sense of how you can use this stuff. And look at what happens here. Now, just as we did before, we want to draw a trend channel in. Now, I first started it from this point and this point, and that's that light red line here. But you can see that we make a lower high in here when we bumped our head against the ice. And the better trend line, we're always adjusting trend lines. This is an art. This is not, it is a science, but it's also an art. And this is the art of it. We have to keep adjusting trend lines. And so we would adjust it, and the proper trend line here is the heavier red line down. And again, if this was A and B, that we bump our head, and C, now we're drawing a supply line in first, because we're in a downtrend, at A and B, and it doesn't have to be at the very top. Well, we started that way, but when we see a lower high in here, and as we come down at this point, we will draw our trend channel a little bit differently. We run it off of these two. And notice as we come up here, near the trend line, we start to get things like hidden up thrusts and other things that Gavin will be talking about a little bit later, where you can take a trade opportunity. Okay? But again, I'm trying to give you this soft focus, looking at the structure and understanding it from that perspective. And we come down. Right? Notice how we come down here. We come all the way down and look at this intersection of trend lines. We have an intersection here of a supply line. I'm sorry, the demand line, and this down. This is the demand line, this red line, and this is the supply line here. And yesterday's low, son of a gun. The market's telling us well in advance that this is where we want to exit our shorts if we get down on that. And of course the market did. So we come back down to support. Then what happens? Again, we start to see that clustering of closes. We start to see the activity occur there. Now, notice what happens here. On wave C, which is this wave up, we see a very nice amount of volume coming in, larger than the last down wave in volume. And we're at support. It's not a surprise, but demand would come, buyers would come in at support. So now we have a potential change of behavior. We pull back. Now we haven't broken the supply line yet, but we're very close to it. And we again see that clustering of closes here. So an aggressive trader might take a long position here. Okay? Because why? Because we're oversold in the trend channel at support with down wave diminishing and buying waves coming into the market. And we're about to break the supply line. If this started to go down here, you would have to jump out of your short. Jump out of your long, exit that long, and take a short, a smaller loss. But you're near the danger point here, where if it does go against you, it's not a huge loss. Okay? All right, day 4. How do we view this? Here's yesterday's market on day 3. We just went through, and we saw trade opportunities in this area and in this area. Notice we're not buying and selling 90 times during the course of the day. Some people do that, but it's not the way I think about trading. I'm trying to take pieces of the swing. I'm trying to take pieces out of the swing, the main swings of the market. And lots of times in the S&Ps, most days in the S&Ps, you get at least 2, sometimes 3 decent swings in the market. Sometimes, some days you don't get that, but typically you do. And you can see that yesterday we had 2 good swings, 2 overall swings. Today, pretty much the same thing, 2 pretty good swings here. That's not unusual in the S&Ps. So we saw a little demand come in yesterday, right? And yet, we're coming down here. And we came down to yesterday's low, and the rally trying to push up above yesterday's low is pretty minuscule. And this is right at the open. This is now 10 o'clock in the morning. And we see no volume coming into the upside here. And we've been dropping down all night. So if there's no demand, then sellers have a chance to try to take it underneath yesterday's low, and that's indeed what they do. And we get a little upthrust in here. And an upthrust reverse the spring, where we have been where the market rallies up, but there's just no demand on that rally. You can see it in the volume. You can also see it in the price bars. They're overlapping here. One bar is up, the next bar is down, maybe a couple up, one bar down. There's no ease of movement here. There's no impulse. We're talking about Elliott wave earlier. There's no impulse move here. There's no new momentum. Just the opposite of what we've been seeing, and what we saw the day before yesterday with momentum coming in. And so then, a little bit of resistance comes in, the market dips down again, and then it tries to rally one more time, and it's very weak. It pokes its head up above resistance, but fails. Yeah, Ken has a question. Yeah, Ken asked the question that the bars are pretty uniform, and is that common on the tick chart? Volume-wise. Oh, in here. Not at this time of the day, no. Ken asked the question for those who are on the webcast, that the volume is pretty uniform here. This is the open right here, the U.S. Open at 9:30 in the morning into 10. Usually that's some of the heaviest volume of the day. And we don't see that at all, do we? We don't see that at all. So that generally means that the overnight activity is going to continue. And this activity has been down, and we see the upthrust coming in, and that's a nice place to take a trade. Okay? But where do we go? We put our 2-day low line in here. I know we can't see it on this chart, but there we are. We're back to the low of 2 days ago. Okay? Market moves between support and resistance. And what I'm trying to show you here is we may be trading off of the equivalent of a 5 or a 10-minute chart, perhaps. But where the buyers and sellers come in is on the higher time frame. So I'm giving you a little look at using multiple time frames here to frame out the structure of the market. So if this is a 2-day low that hasn't really been tested, hasn't been penetrated yet, and it's in this vicinity of where we're trading, then it's going to serve most likely as a magnet for the market to try to go to. And we want to be aware of it. And then we want to look at the activity around the trading around it. And what do we see here? Not a heck of a lot of downside volume. Yes, it's bigger than anything else in the morning, but are we seeing the same kind of volume that we saw yesterday as the market was moving easily down? No, not really. And we see that clustering of closes. Once again, the market pushes down, sellers try to push it down, but somebody's in there buying it up. And we see that by the closes. They all cluster around the same level, once again. Okay? So if you were an aggressive trader, you could make a purchase here, and you're near the danger point. If it goes against you, it's not a big loss to sustain. And yet we don't know what it's going to do. We never know in advance exactly what the market is going to do. But we get a pretty good rally. The other thing we can do also is to lay out our trend channel again. Right? And here we have a phenomenon known as shortening of the thrust. We said that we can construct a supply line and a demand line. And in a downtrend, we see that supply comes in, and that's very nice. We would expect the market to go pretty close to this trend channel, the lower part of the trend channel, before demand comes in. That's our expectation. Okay? We would expect the market to come down to this level. Well, what's it do? It doesn't come down here, does it? It holds a higher low. Or it holds up higher, I should say. Okay? So the thrust, or the wave down from Jack, this is your observation from here, we see larger volume here and no real move down, effort versus result once again. We see the volume come in on this, but we're not able to get all the way down to the demand line. We call that shortening of the thrust. And it's just an indication, it's an indication of one of two things. Either supply is tired out and there's just no more supply available to push the market down, no more selling available to push the market down, or demand is coming in earlier than we anticipated. Either way, it doesn't matter which is the case. The odds are now good that the market is going to rally. Okay? And if it rallies off from here, it's going to break the supply line, and that's exactly what it does. And we start to see volume coming in at B and C. The wave volume start to come in. And so now buying is trumping demand. Remember I said that once resistance has been broken, it will turn into support? There it is, right there for us. Okay? Simple tools, simple use of trend lines, horizontal and diagonal trend lines. It's a perfect location to take a trade. And again, we see demand coming in, good movement coming up here, what David calls ease of movement. We'll talk about that, I'm sure. And then on the wave down to D, notice the volume. It's relatively light. Certainly lighter than the volume at A and B and C. So there's no supply there. If there's no supply and we have demand in the background, which we do, we want to target, we want to trade to the long side. Make sense? Okay. So How do we manage this trade? Again, simple tools. Construct a trend channel up. Now we have, let's go through this one more time so you're clear. We have the demand line here. Right? Demand came in and stopped the market earlier than we anticipated on the low here. So we have shortening of the withdrawals. Demand comes in again at this upper green arrow where we had resistance before. Now we expect it to turn into support, and it does. So we can construct a demand line off of those 2 points. We take a parallel of that. Most charting packages will do this. And we place it on the swing or wave high between our 2 points of demand. That's where supply came in. And that's where we construct our supply line. That gives us the angle of ascent. We call it stride, but angle of ascent is fine. And what do we see up here? We see it is difficult to move the market up. And we'll go through more of a bar-by-bar reading in the next session that I do tomorrow. So you get a bit better handle on how to read individual price bars. Again, I just want to give you kind of an overview here and show you the richness of this method and the opportunities that are available with this method to trade in a fairly calm and logical manner without jumping in and out of the market and saying, is it going to do this, is it going to do that? What does this guy say? What does that tipper rumor? Who's doing what to whom? And what does my indicator say? Oh my God, that's too much information. You know? Too much information. Keep it simple. Keep it logical. So we start to see the inability of the market to move up, and we're at the supply line. We expect supply to come in. It's not a surprise for us. And we've had a pretty good trading day. We've made 2 trades, 3 trades maybe here. 3 if we're aggressive, 2 if we're more conservative. And we've had a nice day. So let's take a look at the last day here. This is, of course, day 4 is what we just did. Let's take a look at day 5. And so yesterday we saw demand come into the market, and we certainly see the up waves having good volume coming in. And now in the overnight, what happens? And for many of you on the webcast, and actually for some folks here in the room, we have folks from Hawaii and from Hong Kong, at least. You probably are trading some of the overnight markets. And so what do we see here? We see a spring, don't we? Right here. Early on, the market dips underneath this support level. And notice it goes back to here. Right? Market's trading around this level. David may talk about this. It's what we call an access line, where the market tends to rotate around the same level for sometimes it's a couple of hours, sometimes it's a few days, sometimes it can be months where the market will do this. You'll see this on daily charts and weekly charts as well. But the market springs off of that support level, rallies up a little bit, comes back and tests it just prior to the U.S. Open. And look at the volume on the test. There's hardly any volume. It's not a bad buy point. Sometimes springs take off immediately. Sometimes they get tested. This one gets tested. Where's our initial target? Well, yesterday's high is not a bad idea. Remember, we're talking about the lows recently. The highs are just as important. We want to always be aware of those. And they serve as a magnet to go test to see if supply is still there. Remember, the market's always in a discovery mode. It's trying to discover, is there more demand or more supply, more buying or more selling in the market? And the daily highs and lows are where yesterday the market stopped because sellers came in or buyers came in at the low. So it's not unusual for the market to want to go back up and rediscover and test. And that's what it does. And notice we get that good volume. It's almost the same as the other volumes, but we're not getting much of a move up here. And then look at what happens here. Suddenly on wave C, on this little wave down, we see volume pick up. The supply comes into the market. And then on the push up to D here, on these little waves up to D, there's just no demand coming in. Well, this could be an upthrust of a larger scale. It turns out that it really isn't, but we're upthrusting yesterday's high, just like we were springing off of the two-day low a little bit earlier. Another good spot for a potential trade. Again, we can construct a trend channel. Again, at the bottom of the trend channel, we start to see the clustering of the closes, where we expect demand to come in. There it is. And then basically we go sideways for the rest of the day, which sometimes will happen in the S&Ps. We might have made a trade here where I have this green arrow. It's in the middle of a trading range. I'm not real excited about doing something like that, especially if we've just not been able to push up above yesterday's high. But if you're an aggressive trader and trading on the smaller scale stuff, you might do that. And that's it. That's a week's worth of trading in the S&Ps, applying this method to give us an inkling about what's going to happen, what's happening in the chart, and where we can make trades in the context of that background or that structure. Okay? I never really looked at background until I read Tom Williams' book back in the early 2000s. I had sent him, it was 50 pounds, I think, at the time. It still is. I had to figure out what that was in America, in real dollars, right? In real money.
Real money is pounds.
Real money is pounds, Gavin says, yeah. So it was, yeah. So I sent him whatever the equivalent was in U.S. dollars, and he sent it back with a nice note in the front. He hand-signed it, in other words. It's one of the treasures I have. And he started talking about the background and how important that was. And it opened my eyes to this. It really did. You know, I certainly stand on the shoulders of David and Tom and Richard Wyckoff in all of this and how I view the market. But the nearby background conditions are really, really important. And that's one of the principles that I go by every single day. What's the back? First and foremost, I'm not looking at the edge of the chart. I'm looking, as I try to state you to do, what's the background saying to us? And Jack asked me if I'm looking at 3 or 4 days because I'm trading interday, and that's exactly right. In fact, I'll start with a weekly chart at the end of the week, and I'll go from there. Always, 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 always attentive to trading around yesterday's high and low. And that can be 2 or 3 days set, depending on what the market looks like. Always comparing the waves, the size and duration of the waves, and also the wave volumes. Always comparing them, as I tried to show you. Always looking for changes of behavior. One day we're coming down, suddenly we get good demand coming in, and we don't have to be flummoxed by that. We don't have to be all of a sudden there's demand when I thought it was going to be a selling day. If demand's coming in, and demand's coming in. Look at the charts and see if you can figure out why. Well, because we're at the 2-day low. That's logical. Demand came in there before, a couple of days ago. It's not surprising that it comes in today, again. Okay? And then we look for trades. Selling climaxes. We see that climactic action. I'll show you some buying climaxes later on. Clustering of closes. Boy, what a nice little indicator, isn't it? You can start to see it, But we need to relate it to everything else that's going on. It's a little bit like a puzzle. Springs, tests of springs, and failed springs. We look at all of those. All of those are good opportunities for trades. The lack of demand, what Gavin will call no demand. Gavin Cummings calls no demand. So we want to be able to see that. Looking at and constructing and adjusting our trend channels. You can see how useful they are, and they're very simple. They're very simple. Now, it's not to say that we're not going to be adjusting them. We are. Sometimes we put them on and the market goes right through them. Okay, then redraw. until we've got the right one. And there will always be a right one, as long as this is a trend. And then breaking trend trends. We saw how demand came in earlier, that shortening of the thrust. It didn't go all the way down to these demand lines. We're holding up a little bit higher. Now we expect to break the supply line. We can anticipate that. One of the things that Wyckoff gave us, he was writing back in the early part of the 1900s, he gave us a sequencing of events. Selling climax, we have a rally from that, we come back and test it maybe once or twice, and then we start to see a good sign of strength and on and on we go. It's the same thing here. That's what we're looking for. There's a sequencing of events. The markets will do things very logically. We looked at lower lows and lower highs to set up trends. We can do it higher highs and higher lows as well. Overbought and oversold in that trend channel when we're getting close to the supply line or close to the demand line. We saw upthrust, effort versus result. We talked about shortening of the thrust. We also talked about how resistance, a little while ago, now becomes support. These are the principles I live by. And these are the principles that show up day after day after day after day in the markets. How are we doing on time?
Not enormous. Could you also read this? How many people
And Gavin has a question. How many people use trend channels in your trading? Just type in a Y or an N for yes or no, and Gavin will get a sense here. Gavin's talking to the group here now about how Tom Williams, when he was a chart maker for the hedge fund, or the syndicate in California, when he first started out, he was drawing charts by hand and drawing trend lines, and he had a 7-foot ruler, 7 feet, that's bigger than me, a 7-foot ruler that he would use to draw trend lines on his long-term charts, because they are so powerful. So they are very, very useful. I think, Gavin, I'm going to stop here. Yeah, it's good timing, and I was going to do a stock chart on a weekly basis, but I think I'll stop here because I can't really do all of that. But let me just go to the end, and let me just do a quick summary here. Good. And then, okay, Gavin just said that he's going to do about 10 minutes now after I finish on the basis of VSA, and then Tom Williams will come in, which will be great. I can't wait to hear him. So let me just do a little bit of this kind of advice to everybody. And remember, we kind of looked at this in a soft way. I'll do a little more hard-edged kinds of stuff tomorrow when I speak. But I wanted to get people set up for the idea of applying principles, and the idea of looking at the background, and the idea of getting comfortable with really what the flow of the market is, or as Wyckoff would say, the waves of the market. Okay? So my advice to you is to go backwards first. Don't jump ahead forward. Everybody wants to go forward. I know, I understand. And I was certainly there, leading, I was carrying the flag on that period, trying to jump forward and then say, no, it's really not the right move. Go backwards. Look at the background first, and understand what the structure is trying to tell us. And we may not understand it immediately, and that's okay. Don't get flustered about it. It will reveal itself to you if you use these principles. Think logically. Think logically. The market starts to change behavior, and suddenly you see demand coming in. Well, that's something. If we're watching the market and we're looking for trading, and it's just supply after supply after supply, and any time there's a rally, it's very deep, we want to be short. Okay? Apply the principles. You've got a basic list of them here. And we'll talk more about them tomorrow. David will talk about principles. Gavin will talk about them. And so will Tom. We're all going to talk about this stuff in slightly different ways because we're all individuals. We're all unique personalities, and we all make things ourselves. This is the hallmark of a professional. We take the information that's out there. We figure out what is workable for us and what's not workable for us. And we take that workable information and we make it our own. That's a professional trade. That's a professional in any industry. Right? And then, most importantly, take your trades in the context of structure, where the principles of the Wyckoff and VSA methods come together and give you a real edge. That's where the edge is in trade. It's not having the best indicator. It's not having, a secret sauce trade setup kind of thing. It just doesn't exist. That's the Holy Grail. And we all know that the Holy Grail is, no one's found it yet in the history of mankind. So, Gavin says he's getting close. Okay, on that note, I will end. Thanks, everybody. I really appreciate the opportunity to talk with everyone, both in here and on the World Wide Web. Cool stuff. Thanks.